do you reckon people lie to themselves about their risk profile?
I would say they do it all the time.
We run into this with clients all the time when a market drop happens, is that it's not if the market will drop, but when it will drop. And I would say, probably like 20% of clients probably get their risk profile wrong and really start to worry because they think this scenario is different, right? This recession is different, but fundamentally they're all the same and the recovery, will always happen.
I think some people don't actually understand the risk of the investment that they're putting their money into as well. We've had a customer come in who had their retirement fund sitting all in shares. And when we talked to them about it, they were like, oh, it's just in a really low risk, blah, blah, blah. And what they meant was they thought that the companies were low risk. But it's all sitting in the New Zealand stock market, which is actually pretty risky if it's your retirement fund. Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today, dealing with financial loss.
Okay, so Mike and I talk to a lot of clients, and dealing with financial loss is quite a big topic that we run into from time to time. Dealing with financial loss is the idea that you've had a bad investment in the past and you can't move forward from it, and it impacts your future decision-making.
Yeah, absolutely. And it's a natural thing, right? Once burned, twice shy. However, these experiences can really hold you back in terms of making good financial decisions because you are afraid of repeating what happened previously. You're an idiot again. It's a pretty natural thing.
Cool. So let's start by explaining what financial loss is. So there's quite a few different types of it. One that's very common, which I run into a lot, when it comes to, I pause because it's been quite a bit of time. Certainly at the start of my career as an advisor, the GFC was a lot more recent. People would talk about 9/11 and the impact on the stock market. 1987 stock market crash was another big one. And people go, I had a bad experience in the share market there, which means I'm not going to look at the share market now. That's quite a common one. Other one is real estate. So people investing into a bad
apartments.
Apartments, bad developments, developers falling over. And the other one is businesses.
Yeah.
So people having startups or whatever it might look like, and they've been burnt. Essentially, a lot of people have had to start again, and then it impacts their future decision making.
Yeah, and it can be a range of different things, and there's a number of things that impact it, right? And like how you feel about it. Age and stage is a big one. If you're 20 and you take a significant financial loss, you probably got time to bounce back. If you're 60 and you take a significant financial loss, and there's some pretty horrible ones out there. There was the case of the financial advisor in Sydney who stole basically all of her clients' money. Family, friends, some of them were getting quite late in their life, and that's pretty hard to bounce back from. But again, it's about making sure that you aren't basing future financial decisions on your result of your previous ones.
And that's a really big one from today's episode is it's not just about the money that you've lost from this bad experience. It's how you've not been able to move on from the bad experience and the impact on all potential future growth, your ability to move forward and grow your wealth off the back of it.
Yeah.
The hindsight game is a very dangerous one to play.
100%. All right, so let's start with the emotional impact of financial loss. James, you've been a financial advisor for over 10 years. Advising clients from Westpac Private Bank all the way through to your own business. In terms of the financial loss that you've seen, what are some of the emotional impacts and how have people dealt with it?
It's a whole range. It's embarrassment. It's shame. It's for those that have spouses and kids. You feel like you've let them down. A lot of the time, dealing with the failure is really hard. And then maybe you might have had a certain lifestyle, and that certain lifestyle has had to change off the back of it. It depends on the degree of the loss of your financial position, but it can be very, very hard to move past.
Yeah, and we saw quite a bit of that with 2021 cryptocurrency, the bull run in the stock market, game stocks even. We had customers who had withdrawn cash from their mortgages and basically gambled it on cryptocurrency. And that is completely gone.
Yeah, I've had customers where they've taken money off their mortgage without talking to their spouse, given it to a day trader, and it started really well, and then they've lost all the money. And you can imagine the conversations within that household at that point, and we're talking like hundreds of thousands of dollars.
Yeah, and that's a really interesting thing, right? Because part of that is a deception where you're deceiving your partner. They thought they would win, but they didn't. I've got an example of two customers who purchased an investment property on the North Shore in Auckland. They did everything right. they got building inspection on the property, went through all the due diligence. However, the building inspector missed the fact that the foundations were basically gone. They were shot, and the house got red stickered shortly after they bought it. And they, I think they've got some type of recourse on the building inspector now because they got a written building inspection. But there is a significant loss to them because that mortgage is still going. And they cannot rent the house out. It's basically derelict, and they've had to keep paying that mortgage.
Yeah, so this is I like in a lot of these situations, I think you probably need to go and get some therapy, which might sound intense, but you need to be able to go and talk to somebody about this is a really big deal, and being able to talk to your family or your spouse about what happened, how you feel about it, all of those sort of things are really important. The next piece, Mike, is then being able to not just try and sweep it under the rug, because I think maybe from an ego perspective and the best way to deal with it, some people just want to pretend it never happened, but you do need to learn from it, right?
Yeah, exactly. So let's say a couple have had a significant financial loss. The loss has happened. They've acknowledged it. What would you say are kind of the key steps in learning from those mistakes?
I think the first thing is you have to, and it's probably a bit painful, and it might not be the day after it happens, it might take some time, but analyzing the past investment is really important. So identifying the mistakes you made in hindsight, what were the signs?
Yeah.
Was it way too high of a risk that you were taking? Were you not in the financial position to be able to do it? Did you not do the right level of due diligence? What were the things that, did you not have enough experience or knowledge in the field? What were, in hindsight, the flags that if you acknowledge them then, you might have been able to change the outcome?
Yeah. So, okay, we're looking at it. We're looking at the different things that perhaps we did wrong or that we ignored. We got caught up in the return instead of looking at the risk. How do you then translate that into lessons going forward? Yeah,
I think you've got to be able to look at it and go, what would we do differently next time? That's probably the big thing, is going, okay, if we were in the same situation next time, what would we do differently? And then you can apply those lessons to whatever you do in the future.
Okay, so we've done the therapy bit. We've looked at the past. We've gone, hey, I made mistakes here, and here. Here's what I'm going to do different next time. Do we then just go and jump into something? What do you think's next?
I think a lot of people fundamentally want to jump straight to the big thing that's going to change their life, and dare I say a little bit lazy.
Yeah.
They don't want to build the strong foundations. They want to move straight to the wealth creation. So I think, and there is some examples where if you had better financial foundations, maybe the outcome might have been different as well. If they had a little bit more cash at it, if you had a little bit more in reserves, it would have been okay. So I think building strong financial foundations is the first, tick box exercise I would go through.
Yeah, people's want to just start swinging for the fences every time in terms of a financial investment or outcome, especially after they've had some type of financial loss, is absolutely wild. It's almost like they're like, I've got a shorter time period now. I've got to swing bigger, which we know, more risk, more return. However, the more risk is what you've got to focus on there. And what is the downside risk if it actually turns to crap?
Yeah, and the other big thing is you have your mates wax on about all the investments that they've got, and they've done these things and it's worked out really well. One is they might have different skills and experience to you, which might mean they might be able to navigate the waters. Second, nobody ever talks about their losses. They only talk about their wins.
Yeah.
So if you were just getting this picture painted of somebody being like, look how successful this person is, I should take the same level of risks, the outcome might be completely different for you.
Every time I hear someone say that type of thing and I don't know them, I have it. I'm just like, I'm like, yeah, you've added GST to the story because you're in front of people you don't know. I have it straight away.
Don't we all?
Yeah.
Yeah. So the first thing I'd say in terms of the strong financial foundations, big emergency fund. Bigger the risk, the more cash you need to have on board, essentially. If you do not have an emergency fund, you are asking for trouble in life. Things will go wrong, and if you're taking risks, there is a higher likelihood for it to go wrong, so make sure you've got a chunky emergency fund.
Yeah, absolutely. Another one here is just around debt management. So you've got to make sure that you have your debt management kind of criteria and levels in place before you start making investments. What I mean by that is if you're let's say you've got $200 to feed into a managed fund at the end of every week, but you've got a $5,000 credit card sitting over here. That $200 per week is not going to outperform that credit card. You've got to pay that off first. So it's about looking at your holistic financial position, not just focusing on the investment that's going to get you out of this hole and, return you to the top of the pile because you had some loss in the past.
Yeah. And financial literacy. So of course, you're listening to checks and balances. So you already know it's important to improve your financial literacy. But if you do not improve your knowledge around money, then the probability something will happen again is much higher than if you understand whatever you're interested in a lot more detail, the best practices in the field.
Right. So next step, right? We've got, we had the loss, we've worked through it, we've kind of figured out what went wrong. We've then built some solid financial foundations, right? We're going to do it right this time, and not just the investment. We're going to do the whole thing right. What do we do now if we want to go make another investment? How do we make smart investments?
Yeah. So the first bit is around the research and due diligence. So maybe in hindsight, if you've been burnt in the past, if you did the research and the due diligence in a bit more detail, you had the right team around you, specifically around a really good solicitor in whatever field that you're looking at. This is mainly talking around the property aspect. But if you're talking to a financial advisor or an investment broker or something like that, you'd probably want to research like how long they've been doing it, their track record of the funds, compare to historical returns. Do they use a custodial? Like, does the financial advisor ever touch the money? You want to take all of those steps to understand exactly what's going on here. Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
Next point is around diversification. So we like to have all of our eggs in one basket sometimes. We like to do things that we know property investors are probably the most guilty of this. and I certainly think a lack of diversification to a point is fine, but at a certain point, you need to go. Diversification is about spreading your risk because investments will perform, greater highs, greater lows, but you'll average out at a different point. Risk assessment. So you need to, do you reckon people lie to themselves about their risk profile?
I would say they do it all the time, right? Everyone's like, again, I don't know if they lie to themselves about their risk profile, but they see the potential returns and go, I can deal with whatever risk that kind of, because if you go through someone's risk profile with them, they might say they're a little bit less risk averse than they actually are. But I would say the returns, when you put a return in front of someone that says you can get 12% in this fund or 3% in this fund, they just think I'd be an idiot not to go for that one.
Yeah. Yeah. So I think the risk assessment is, and the share market's a perfect example. We run into this with clients all the time when a market drop happens, is that it's not if the market will drop, but when it will drop. And I would say, probably like 20% of clients probably get their risk profile wrong and really start to worry because they think this scenario is different, right? This recession is different, but fundamentally they're all the same and the recovery, will always happen.
I think some people don't actually understand the risk of the investment that they're putting their money into as well. We've had a customer come in who had their retirement fund sitting all in shares. And when we talked to them about it, they were like, it's just in a really low risk, blah, blah, blah. And what they meant was they thought that the companies were low risk, but it's all sitting in the New Zealand stock market, which is actually pretty risky if it's your retirement fund.
For sure. The last piece is around having a long-term perspective. So once again, this using the share market as an example, people go, what's happened? Look, term deposit rates are high. This portfolio has dropped backwards. This portfolio is going to take a while to recover. But really, if we're talking about retirement and we've got 30 years, a 20% drop is irrelevant in the bigger picture. And it's just important to just think about it over a much longer term than over what's happening, how much. I have some clients, I don't think I have any moment, but in the past, the clients use a spreadsheet and track their daily balance. And as soon as they tell me that, I'm worried about that they're thinking very short term.
Yeah.
The best clients are the ones that lose their login because they're just leaving it alone. We've agreed on a risk profile. We'll see when we've made some returns.
Yeah, 100%. So we've done the due diligence on the new investment we're going to do. We've got our good foundations ready. We're ready to kind of make the investment and sit in that risk profile for a long period of time. But there are going to be some psychological barriers to you actually doing that. James, talk us through some of them and tell us about how do you manage them?
Yeah, I think that people have been burnt in the past, right? And when we're talking about some of those emotions around embarrassment, the feeling of failure, if families are involved, etc., like the fear and the anxiety to do something else is going to be very, very intense. And you're not going to, I think, like trusting yourself is going to be really hard. The avoiding, like, how do you know you're making a good decision? How do you know you're not making an emotional decision? Is really, really hard. What I would say is you need to be as black and white around this as you possibly can. Remove all emotional decision-making and go, essentially, you've got to pretend that you take the lessons. You've got to pretend
the loss didn't happen.
The loss never happened. That is in the background. That does not happen. That does not involve my decision-making. The piece is going, right, what is the risk of this investment? What are the potential returns? Have I done my due diligence? Do the numbers stack up? And then going, have I got external support? Because if you are concerned about your decision-making because you've made a bad decision in the past, if you've got people that you trust with the right experience, and maybe you've got a couple of different people that you're talking to, then you have to pull the trigger. And you have to have a positive mindset and make that investment. Because the problem you've got is there's just not the risk of making a bad investment. There's the opportunity cost of making no investment. And that's the really big thing I see in this space is people sticking cash or they're in term deposits because they don't want to be burnt again because they've been burnt in the past. But that means you're leaving a huge amount of money on the table, which can impact what you can do in your life in the future. Yeah,
my advice around that would just be to slow it down. So slow down the decision-making process, slow down what you're actually doing with the investment. We get, just with the industry we're in and, who we operate with, we get a lot of really good investment opportunities and deals and things that come across our desks. But it might have a 3, 4, 5 day window on it to get in there because it needs to be under contract or it's, distressed in some way. And even for us, it's really important to slow that decision-making process down. I can't change the time frame, but what I can do is change the way that I'm thinking about that decision. And if you've been burned in the past and someone is putting a deal in front of you that requires some really quick thinking and, is putting you under pressure, I would challenge you to think about whether or not you should even be in this position, or whether or not you are swinging for the fences, because that's what those usually are. And I'm not saying they're all bad. Some of them are quite good, but I would challenge you to think about whether or not you should be thinking about this or whether or not you should just be saying, this one's not for me because, I just need to do a bit more due diligence.
Yeah, that's a really good point. I think if it takes you 6 to 12 months to make a decision on, pulling the trigger, that's completely fine. My concern is, you're right. If anybody's trying to rush you, like, there's always going to be something else that pops up. Just move on from it. But if it's taking you, we're talking years, and we do have those people where they never pull the trigger, and there's the implications. I think the other thing you can look to do is you don't have to that. A lot of it's about building back up your confidence. And you don't have to swing for the fence with the first one, right? Say if you had a property development and you lost everything, you're probably not going to go back to a property development as the first one. You might just buy a standalone house as an investment. So you've got some exposure back into the property market. Or if you were day trading and lost all your money, you might start with like a diversified conservative portfolio. And just continue to increase your risk as you feel more confident.
God, there's probably a great analogy somewhere there, but I can't find it. Around Brendan McCullum going out for the World Cup final against Australia, swinging for a 6 off the first ball, clean missing it, swinging for a 6 off the second ball and getting bowled straight away.
Mitchell Stark in swinging Yorker. It was a beautiful day.
It wasn't for me. Cool. So we've talked about some history there, how to kind of manage your emotions and your decision-making process so you can invest again and make better choices. You and I have been financial advisors for quite some time. We haven't actually talked about this right before the episode, but I've definitely got some case studies and examples of people making bad decisions and then people making good decisions after they've had a bad experience. You want to go lick for lick? Who's starting?
Yeah, the one that comes to me is a couple that I'm working with at the moment where they invested into like a leaky apartment building. And essentially they lost everything. I'm working with them at the moment, and as it's as much to do with the psychological elements as anything else. And where we've got them a new build investment property, and we've talked around, okay, based off the developers, let's look at how many houses they've built. Let's look at your financial plan if you buy this versus if you don't buy it. And they were really good to be able to park what has happened in the past and move forward.
Yeah.
So I'm really proud of them.
Yeah. I think mine probably I've got two. The first one around the loss for me, or the ones that I find frustrating, are actually not where people, I find the ones where people have made just straight down stupid decisions, like some of the crypto stuff, quite frustrating. Although everyone thinks they're going to get a good outcome off the back of it. So I kind of see it to a degree. The ones that really get me frustrated are where people have not done anything or not made a decision, and that's it's gone wrong, i.e. not having any form of insurance cover when they're taking huge risks. I find that just completely frustrating, or not getting around to updating it when they are self-employed, taking risks, doing this investment. And it's not so much the investment that hurts them, it's something goes wrong and the wheels all come off. And I know that's slightly tangential to what we're talking about, but I find that very frustrating. I'm working with a couple at the moment though who did everything right. Bought, first home buyers, bought a townhouse, city fringes, not too far out, not too extravagant or anything like that. Definitely didn't ramp themselves up in terms of the amount of debt they were taking on. And they bought peak market 2021, and they've lost a fairly significant amount of cash. The development that they bought, there is now quite a bit of housing, New Zealand kind of social housing that's going in right next door to them. They're worried that is going to actually decrease the value of their property further. And we've been having a couple of meetings over the last few months about them selling and actually going and moving somewhere else. And we've got to a point now where they're going to hang on to the unit, and they're going to rent it out as a long-term investment property, because if they sell it now, they'll crystallize that loss, right? And actually, we know simply because of inflation that if they hang on for 10, 15, 20 years, probably going to be fine. And what they're doing is they've found another way to get some deposit, and they're going to go buy a second property somewhere, probably where they want to live when the market is down, so right at the bottom of the market. So instead of selling a property, crystallizing a loss and thinking, oh, we really had a bad experience here, we've worked through it to a point where they're now going to build a property portfolio and just say, hey, the bad one may have not been so great in the short term. Also, the first house may not have been so great in the short term, but it's going to be good over the long term. We'll hang on to it.
That actually makes me think of something that's impacting quite a lot of people as well, is the whole, my house is down in value. I've invested some money in my house. I'm planning to move, but I'm not going to move now. Yeah. I'm going to wait for the property to go up in value. But actually, that's completely irrelevant. It's all about, the cost of the current house versus the cost of the future house. And if you're buying that next house at a discount and the current house is still like, you get it for an okay price, what's the net outcome, as well as something we're seeing for lots of clients at the moment.
All right, James. So we've talked through a bit about loss, what people can do, deep dive into some emotional effects and how you can make better choices. But before we wrap up, let's give them some quick tips and takeaways. So what should the listeners do?
Yeah. So the big thing is you've just got to realize that at the end of the day, you do need to park what's happened in the past and move forward. You need a step-by-step plan to make sure that you can focus on growing your wealth. It happens so often where people can't move past this. They stay in hindsight, what could have happened, and not focusing on the future. So make sure you do your due diligence. Make sure you've got good financial foundations moving forward, and take action, because if you do not take action, you're going to be stuck where you are forever.
100%.
Okay, thank you very much, Partners Life, for sponsoring this episode. Please give us a like, subscribe, review. We'll catch you next time.
Cheers.